You're back with Business Center. With global markets coming back with a bang in 2003, companies are once again looking to raise cash through initial public offerings, none more so than firms from China. Last year, the world's largest IPO was China Life Insurance's $3.5 billion dual listing in Hong Kong and New York. And this year, at least 5 mainland firms are looking to raise $1 billion or more. CNBC's Cheng reports.
The gold rush is on. In 2004, Hong Kong is expecting $13 billion worth of new China IPOs, almost double the amount issued in Hong Kong in 2003.
They've been jumping on the bandwagon of Chinese new issues, irrespective of quality, often irrespective of price, in anticipation of a very, very rapid return, which is why we've seen the traditional characteristic of vastly oversubscribed IPOs.
Why the buzz? China is the world's fastest growing economy. Beijing is opening up key sectors following entry into the WTO, and the government is pushing reforms in its financial system.
This year, I believe, will be a great year for financial stocks, that including banks and insurance companies. And the banks already, published in the media that there are at least 2 banks are coming from China this year: China Construction Bank and China Minsheng Bank. And China Construction Bank, together with Bank of China, in the new year, as you know, already had capital injection about 4.5 billion from China's authority. That means it will push forward the whole financial banking sector reform.
Last year, the world's largest IPO was China Life Insurance. It was one of 20 IPOs from Chinese companies in Hong Kong that raised a total of nearly $7 billion. The frenzy saw the Hang Seng H-share index, which tracks shares of Chinese companies listed in the territory, soar about 150%. This year, the index has lost over 1%. But Merrill Lynch doesn't think the correction is enough. According to its January research note, excessive valuations, excessive optimism on the potential for further ratings, and a truly excessive-looking equity issuance pipeline make for an unpleasant cocktail. Other analysts, too, are increasingly cautious.
I think for the retail, you got to look at the 2 sides. The retail side will continue to, probably for smaller issues, they'll continue to buy these stocks or punt these IPOs. For the institutions, I think they're becoming more selective already. They have to be selective. They cannot just punt stocks. Punt IPOs. They may put more effort or put more support behind bigger IPOs than smaller ones. Yeah. So I think we're going to see some rationalization in the coming months.
That rationalization is leading smaller Chinese companies to look elsewhere to raise cash. Singapore, for one, expects 25 IPOs from mainland SMEs this year, including companies in food and beverage and services. But for authorities here in the Lion City, the size and private nature of the companies mean it's a delicate balancing act between growing the market and retaining its quality.
And then if you go into a small company in China or India or wherever Singapore is seeking to have listings or seeking to attract companies to list in Singapore itself, the risk increases because obviously the authorities in Singapore have jurisdiction over what goes on in Singapore, but not jurisdiction about what goes on in Shanghai or Bangalore or wherever.
Despite such words of caution, the Chinese IPO buzz shows no sign of dying down. For now, at least. Cheng, CNBC.